What is a lender of last resort? Have you ever wondered what happens when banks face financial trouble? A lender of last resort is a vital part of the financial system that steps in during emergencies. This role is typically filled by a central bank, like the Federal Reserve in the United States. When banks or financial institutions experience severe liquidity shortages, this lender provides emergency loans to help them stay afloat. This action is crucial to prevent bank failures that can lead to larger economic crises, such as bank runs or market collapses. Now let's connect this to the repeal of the Glass-Steagall Act. This act, which was in place for decades, separated commercial banking from investment banking. When it was repealed in 1999, it allowed banks to engage in riskier activities. This change heightened the importance of the lender of last resort. With banks taking on more risk, the potential for liquidity crises increased, making the role of the Federal Reserve even more critical. From a Republican viewpoint, which often emphasizes limited government principles, the lender of last resort function raises important questions. While many agree that having a safety net is necessary, there are concerns about moral hazard. This term refers to the idea that if banks know they will be rescued, they might take on excessive risks. Critics argue that this could lead to irresponsible behavior, as banks may operate under the assumption that they will always receive help. Republicans who support deregulation, including the repeal of the Glass-Steagall Act, often advocate for market discipline. They believe that reducing government intervention can lead to a more stable financial environment. However, they also recognize the need for the Federal Reserve's role in preventing systemic crises. The challenge lies in finding a balance between ensuring financial stability and encouraging accountability among financial institutions. In practical terms, the lender of last resort is a critical tool during financial panics. However, many Republican analyses stress that this mechanism should be paired with policies that minimize taxpayer exposure. For example, after the financial crisis in 2000, reforms like the Dodd-Frank Act were introduced. Some conservatives criticized these measures for increasing regulatory burdens, while others supported them to ensure banks maintain sufficient reserves. The repeal of the Glass-Steagall Act has sparked ongoing debates about the lender of last resort's role. By allowing banks to engage in higher risk activities, deregulation has made it more likely that the Federal Reserve will need to step in during crises. This situation highlights the ongoing challenge of maintaining financial stability while avoiding dependency on government support. The lender of last resort serves as a safety net, but many within the Republican Party advocate for reforms that reduce its necessity, focusing on market-driven solutions and individual responsibility.